In this video, I'm going to demonstrate the corporate insured retirement plan, and I'm going to use Aaron and Cynthia. They own a business, or Aaron does. We have their ages up here. So at age 57, they have a current net worth of just shy of about $2 million. The dollar values are on this side, and the years are down here. If we break that up, we can see what that consists of. So they have a home, some vehicles, a non-registered portfolio. These are the tax-free savings accounts, RRSPs, and the shares in the corporation, and some cash value in the insurance. If we look at their spending, we can see, if I just run my cursor along here, we can sort of see what they're spending over time each year. So we can see as they get older, they are spending less money. Out here to about age 85, where we're spending about $75,000 a year. Let me just click on a retirement age here, and we can see where they're spending. So about $20,000 on the home, lifestyle expenses. So there's about $90,000 a year here. This is money going to tax-free savings account, and you can see the other amount. But just this is what they want to spend in retirement. And of course the green, this is money coming in, and we'll touch on that a little bit later. Now they're also making investments, and I'm assuming that they're going to invest in a portfolio of about 60% stocks and 40% bonds. And I've turned to FP Canada guidelines just to give me some direction on what rate of return that should be. The total rate of return is about 5.09%, but of that, some of that's coming from interest income. There's some dividends, some foreign bonds or dividends, capital gains. Total return after MERs is about 5.09%. And then on top of that, the advisor is charging a fee of 1%. Now I mentioned Aaron owns a corporation, so let's take a look at the corporation here. He owns Acme, and what Acme is doing is it has some surplus income there of about $100,000 a year, and it's sending a dividend into Invesco, where he's investing the money. And we can see that growth on the investments right here. That's represented by the green. And then of course, once they retire, they'll be taking dividends and paying themselves here. This light blue area, this is actually the value of Acme. I didn't sell the value here. You don't want to be dependent on a sale of your business for your retirement plan, so I've left that for now. So again, for retirement income, they have their RSPs, but they're also sending out dividends, which we can see here. We'll pay some ordinary dividends, and we're going to start them here 2029 and pay them out of the company. And dividends to Aaron and to Cynthia. And when we do that, and then we come back to their net worth, which we've seen over here, we can see that everything works, and when they both pass away, each of the kids are going to receive about $3 million. Let's take a look at the corporate insured retirement plan now and see if there's a way that we can improve this in the tax situation. So now I have the corporate insured retirement plan up, same investment portfolio, and let's take a look at the setup on this. So we have the life insurance. We bought a whole life insurance policy, and we're going to make premium payments of $40,000 a year for 10 years. We're only going to do 10 years because Aaron's not sure what his income is going to be like after that point in time. So we've got a policy guaranteed paid up in 10 years. And with that, we can buy a policy that has a death benefit right now of about just shy of $500,000, and we can see it growing over time. And then the cash value on this policy is about $18,000 in the first year. So I guess the other $20,000 or $22,000 went to pay for the cost of the insurance. But we can see it growing over time. And then what we're going to do is we're going to take a loan from that cash value. So I'm just going to tell the program here, let's set up a bank loan. 2030, we're going to start to draw or borrow this amount of money, which happens to be the dividend payment that we want, from the policy, and we're not going to pay the interest on that, but we can see the loan accumulating here, and it's going to continue to accumulate as we borrow, and then eventually it will be paid off when the death benefit pays out, or when Aaron and Cynthia both pass away. So which is the better strategy? Well, here I've got them side by side. So here we've got doing no insurance in the corporation, and here we have the insurance in the corporation. And we can see if we look at the charts, they're pretty close, but there is a slight advantage here to doing the insurance. If I take a look at Sam, let's just take a look and see what he would receive on death. Let's look at the total net worth. Total net worth, no insurance, about $3 million. And on the other side, with the insurance, Sam would receive about an extra $370,000. And of course, so would the same story for Beth. And if I look at the corporations here, again, this is the value of the investments in the corporations coming down, and this is the amount that's left in the corporation to go to the kids. And here we can see the insurance pays off, and there's about this much left in the corporation to pay out. So we can see an advantage here. It's hard to see here, but if you look, the total equity in the corporation is a little bit lower in the early years with the insurance, but it does build up over time. Now, I've assumed the 60-40 split in the portfolio the whole way through, but what if you're an aggressive investor and you're going to do 100% stocks? So I thought I'd take a look if you do the 100% stocks. But the other thing is, if you're an aggressive investor, you might do 100% stock, but on the insurance side, if you think of the insurance taking the place of a bond portfolio, then you might have your other investments at 100% stocks, right? So I've just taken a look. Let's just do a 100% stock portfolio on both sides. But again, insurance on one side and no insurance over here. And again, we can see it still looks in the end like the corporation comes out ahead. Let's take a look personally. And again, no insurance here. Have the insurance on this side. There is a gain, it looks like. Let's take a look and see what the kids would receive. We go to Sam, and we can see here 3.9, 4.25, so sorry, 4.17. So still better off with the insurance. Anyway, if you're thinking of doing something like this, it always pays to go and talk to an insurance professional or an advisor. Dividend rates on insurance policies can change, but this gives you a good summary of how the concept can work.